This one is on the insurance market. And with me on the panel are three eminent experts and participants in the market. We've got John Nelson, Chairman of Lloyd's, Nigel Wilson, CEO of Legal & General, and Sir Adrian Montague, Chairman of Aviva. So just to kick off, how do you each think Brexit's going to impact the UK insurance industry? And of course, we've got different bits of the insurance market here, so we need to break it down and follow the thread across each bit. Maybe I'll start with Adrian.
Well, I think you're absolutely right, Barney. There's no universal picture relating to the impact of Brexit on insurance because everyone has slightly different business models, slightly different businesses. In Aviva's case, we're fundamentally a retail business, lots of operations in Europe already, but they're all locally established, locally regulated, locally capitalized. And that means that we are sort of Brexit ready. We don't have to do major structural surgery, with the possible exception of Ireland, where we have a branch which will have to be reincorporated. And there is some frictional difficulty about commercial risks that we write from London, some frictional difficulty in asset management. But fundamentally, for the retail businesses, I think Aviva is an exemplar of that. It's relatively straightforward.
Thanks, John. And we'll pick up reinsurance as well, I think. Cover insurance.
Right. Well, I think if you look at the London insurance market, and here I really mean general insurance, specialist insurance, wholesale insurance, including reinsurance. Just to give you a couple of numbers, the total gross written premium in London is running at about 60 billion sterling a year. In fact, Lloyd's is about half of that, about 30 billion. Employs 50,000 people, 350 firms, and as you know, there's a big infrastructure around it, all interconnected. In terms of the impact of Brexit, I think, I don't want to dodge the question, but I think it depends a bit on who you are. If you are Lloyd's the only insurance market in the world, then we are not, although we are Lloyd's of London, and most of our businesses in London, in practice, we have gone more local worldwide. So if you look at China, Singapore, Middle East, South America, and really what this is forcing us to do is to go more local in Europe. And you've probably seen that we've announced some plans, which I can talk about more specifically if you wish later, to make sure that we can continue to write the business on the Lloyd's platform in the EU. I think in terms of the impact on the London market, frankly, I don't think it's going to be positive over the medium term. I think though that the London market is so strong, both in terms of people, the infrastructure we have, the innovation we have, dare I say it, the regulatory regime we have, which needs some modification, but I think it's the bones are there. I think London will remain a very strong, the strongest centre for commercial insurance and specialist insurance in the world. But I think that we will see at the edges some pushing out from London.
Nigel?
Yeah, I rather agree with Adrian. We were meant to create a pan-European Solvency II level playing field across Europe. The one thing we've actually not done is create a pan-European level playing field across Europe. And as a consequence of that, each market operates pretty independently of all of the others. And you need to have a local presence, local business model. And so the existing business models across Europe are not actually going to change that much as a consequence of Brexit. What it will do is, and hopefully will force some of the UK players to look at the opportunities that lie outside of Europe, recognizing there's going to be turbulence in Europe to a certain degree, and therefore looking in Asia, where there is, I think, massive opportunities for UK firms that we've not fully exploited, and indeed in America, both North and South America, where we've been very successful so far, but the scale-up opportunity in these businesses is huge from our point of view, and I think for the other UK firms. So one of the unintended consequences of it is it's not going to change Europe very much for any of us. It will change our ambition in Asia and in United States, like many other firms. I think that's going to happen in many other industries as well. And we've got to seize those opportunities and drive greater growth for our firms outside of the UK, outside of Europe, into Asia and the United States.
And just now then, just again turning back to Europe, what steps are each of you taking to mitigate the impacts of Brexit, or maybe in Nigel's case, not, but perhaps you could elaborate on that.
Well, a bit like Adrian, we're shuffling a little, one or two people in and out of Ireland is basically the only measurable step that we're having to take. And so I think Brexit will force greater consolidation across Europe, because many of the financial services are very inefficient. We've seen that process start already in the UK, as some of the AXA and Aegon and various other firms and have been disposing of parts of their UK businesses, and indeed we've got rid of one or two of our European businesses. So people are recognising this is a decision-making event as much as anything else. It's not actually a big change to the business model that we currently operate.
Of course, in the Lloyd's case, there is a big change in the business model, because being a market, we operated from London using passporting right around the EU. So we concluded, we'd actually been working on it in the lead up to the referendum, but immediately the referendum came, we decided we had to act quickly, really to give our stakeholders confidence that we could write business onshore EU. So we have announced our intention. We're in the process of doing it now, setting up a subsidiary in Brussels, which will allow our underwriters in London to write business. In fact, I won't go into the plumbing, but in much the same way as they do today. It will obviously require a bit more overhead cost, but we think that we will be able to operate pretty well seamlessly as far as our customers, the large insureds and the insurance brokers, are concerned. We do see actually some opportunities here, because if you look at the Lloyd's market, the global hub for specialist insurance and reinsurance, our penetration rate in the EU is quite low. It's about 11% of our total market. And we think that by going onshore EU, it can only help that penetration rate increase. And the second reason is that we think we've come up with a formula for international insurers, general insurers, which is extremely efficient in terms of operating within the EU, i.e. these are carriers from outside the EU, which may well attract more business onto the Lloyd's platform, more EU business onto the Lloyd's platform. So those would be two sort of medium-term, not short-term effects. But as I say, we had to act quickly. We've done so, and we will be up and running so that on January the 1st, 2019, we will be writing business within the EU as before.
A little like Nigel, I think, in terms of immediate changes, almost none. I mean, a bit of shuffling around in Ireland, which is a good way of putting it, Nigel, and some reorganisation of the commercial business we do in Europe. But I think we have one longer-term interest in the way in which the negotiations come to conclusion with Brussels, because for Aviva, like many firms, fintech is becoming an increasingly important part of the way we do business. I mean, we are trying to digitize the whole of Aviva's engagement with the customer. And so we rely on very good entrepreneurial talent that we draw from all over the world. The chap who's designing our customer interface used to design computer games in Silicon Valley. And that's just one example of how we've drawn in all sorts of talent from around the world into London. And for us, I think like every other big international group, the ability to move talent not only in and out of London, but around the world is a very important part of the way we conduct our business. And if we find the shutters coming down around the UK, then that will be an inconvenience to us. It won't be fatal, because we can do this work overseas. We've got digital garages in Canada and in Singapore, and a big digital business in Poland. But actually, we want the centre of that activity to remain in London. And so it's important from the point of view of immigration that talent has free access in and out of London.
Just to build on that and then picking up on the opportunities from Brexit, what are they and what do you think the UK then, in addition to concerning itself with the movement of talent, needs to do to cement them?
Well, I mean, as Nigel said, there is a proliferation of opportunities around the world. Aviva has always been a very strong player with a sort of fortress business in the UK, both in life and in general insurance. But we work in 16 or 18 countries around the world, and the opportunities out there are huge. I mean, we're doing a lot of work in the Far East at the moment. And so I don't think we have ever had a natural preference to invest in the UK. It has been our biggest area of investment. But if you've got tight rules for the allocation of capital, you go where the opportunities are strongest. And we will look at the world on that basis. And so I think perhaps speakers on an earlier panel were saying that perhaps what Brexit will do is slightly change the focus. So you look more to the international opportunities than to opportunities in Europe. I think we do that already. Perhaps there's a marginal effect in cementing that focus in place, but it's a small change.
I think in the Lloyd's case, obviously 75% of our business is outside the UK and the EU. So our strengths have always been in those third countries, particularly obviously the United States. I don't see Brexit having any impact on our strategy in the sense that we have been prosecuting a very energetic strategy in terms of improving our global market access in Latin America, in the Middle East, in Southeast Asia, most recently in India, and of course in China, where we've grown very well. So I think all it will do in one sense is to reinforce our strategy and increase the energy we're putting into it. But as I said earlier, I actually think that in terms of the EU, which partly for industry structural reasons has not been a hugely large market for Lloyd's of London, it may actually improve because in a sense, we've been forced to put down facilities onshore.
Yeah, as I mentioned earlier, there was one of the unintended consequences, and Adrian just echoed it, there are enormous opportunities for UK firms outside of the UK, both in Asia, but inside the UK, we've seen a huge mood change inside the UK, where people look now at London, not with envy, but they want to copy the success that London's had. And I think you've heard from all three panel members, we've all got very resilient business models, and we're not too fussed about the consequences of Brexit. But what we're seeing in Leeds and Manchester and Newcastle and Birmingham, Bristol, Cardiff, etc., is local politicians and local business people suddenly realising actually there are consequences for Brexit for them, that in fact all of their people voted with a much higher percentage of it's not the 51-49, it's the 65, it's the 70% vote to leave. What are they going to do to help that local economy and replicate the success of London outside of London? Because I actually share the view that my two panel members have, which is actually we'll manage our way. We've got really clever people here who will manage their way through some fiddly bits around the Brexit, but we'll get through that. The rest of the country has to really step up. And there are huge issues around the rest of the country, particularly productivity, low wages, the inequality that exists between the cities and London, which now need addressing. And people, for the first time in 30 years, in my experience, are stepping up in Manchester, Leeds, everywhere. And that's a fantastic thing to see. And it was something we didn't expect in the run-up to Brexit, because that wasn't part of the discussion, is that definitely people are stepping up outside of London, wanting to make a difference, and really recognising that they have political and economic and social accountability to the electorate to deliver on what that electorate looked forward to, which is a brighter, better future.
I just can't resist picking up just on that, just to ask, do you see then a possibility that the regions could be competing with EU member states, in fact, to get a bit more from London, so that this could be a win within the UK as a whole?
Well, I think not just within the UK as a whole, I think they'll get more capital in general. Is that one of the things that's really the UK is a great place to invest, and with all the political turbulence that's going on in the rest of the world, it's become an even better place to invest. And so whether you are European pension funds, who we have co-investing in building institutional housing assets here in the UK, which was, again, something we didn't expect in the run-up to Brexit, we've seen a greater interest in actually helping to facilitate the investment elsewhere. And I would agree with your main theme there, that in fact the regions will be competing for capital in a really meaningful way, not just from the likes of the Aviva ourselves and other big institutions in the UK, but from global institutions as well, who see the political stability, the legal stability, the property stability that you get in the UK as a fairly unique thing to be happening around the world. And interest rates are very low. And therefore, the returns you can get from these activities in the UK look compellingly and mouth-wateringly attractive to international investors. We have to step up and go and get that money, not just from ourselves, but from the banks who are already in the UK, who underinvest in SME firms, to be frank. And we have to get everybody to work together to help deliver economic growth in the UK.
John, Adrian, do you want to add anything on that topic?
I'm with Nigel on this. I think there are gigantic opportunities, both in hard and in soft infrastructure around the UK, for pension funds, for insurance companies, for overseas investors. But there are a couple of things that you might want to tinker with. The Great Repeal Bill is going to it sets out to create English legislation that replicates 40 years of European acquis. It's a task which I'm glad I'm not responsible for, because it's going to take many years to complete. But in that process, we are going to bring European regulation into the UK, into UK law, directly, not indirectly, as we now do. And you can't just bring it in without any changes, because Solvency II, for example, is peppered with references to Aviva and other European institutions. There has to be some process as an adaptation. Now, I think all of us have got used to insurance company regulation. We've spent, I'm sure Nigel has spent, hundreds of millions of pounds getting our systems ready to implement it. And absolutely, the last thing we need is a whole-scale change, and I don't think that's on the cards. But there will be an opportunity over time to review some of the finer details of Solvency II, but it will need to be done in a way that does not prejudice ongoing relationships and whatever basis of mutual recognition is eventually agreed with Europe. So it's a very delicate exercise. But there are some inhibitions in Solvency II against insurance companies investing in some of the hard infrastructure assets. It will be worthwhile as we move forward to re-examine how much flexibility the insurance sector might have in that aspect. And I think there's just one other thing as well. Solvency II is, I think, several hundred pages of primary legislation, several thousand pages of secondary legislation, and several tens of thousands of pages of guidance. And you'd hope, perhaps this is a vain hope, you'd hope that it could become a bit more straightforward, a bit less burdensome from a bureaucratic point of view. I think there are opportunities there. But none of these are for the short term. I mean, the last thing we ought to be doing is changing or inviting anyone to change the rules precipitately. The rules are there, they work, everyone's perfectly comfortable with them. This is very much just a long-term process of anglicising what comes out of the Great Repeal Bill.
I wondered how long it would take before Solvency II came up. I agree with entirely with what Adrian was saying, that I think from our point of view, we think, certainly in our space, that Solvency II as a principle for capital setting has been actually very beneficial. Funnily enough, parts of it were modelled on the Lloyd's model originally. And I think it's been in one sense, in points of principle, a good exercise. But as Adrian says, it is far too, what's the word I want? It's far too process-driven far too clunky in terms of regulation, documentation, and so on. And right now is the wrong moment to attack that, because obviously what we need, certainly for the time being, is as much equivalence as we can get. There are, though, some issues in Solvency II still on things like currency hedging, which actually drive the wrong behaviours, which need to be reformed in due course. In our case, and I know in the life sector, they've got other issues as well in terms of long-term assets and so on. But I do think that it's something that post the Brexit negotiation completion, we as a country need to look very hard at trying to simplify and make more efficient the implementation of Solvency II. If I told you that the documentation for the Lloyd's internal model, if we printed it out, would be 2 stories of the Lloyd's building. Now, that actually, we know that no one's ever going to read it. So why do we have it? Anyway.
Yeah, I won't add to the Solvency II debate. But I do think, the banks in this country are in good shape, Barclays is in good shape, Lloyd's is in good shape, the major building society is in good shape. We're all in great shape. And we're very big. On a global sense, Aviva's a big firm, Legal & General's a big firm, Pru's a very big firm. And so we can compete on a global level. We're not at a competitive disadvantage from scale whatsoever. And we have got some Solvency II rules to get around, but actually the opportunities for us are just immense. And in a sense, the nervousness around Brexit caused us to focus more on these growth opportunities that existed elsewhere, and to develop, a better mojo, better confidence about our capabilities. And we're finding, a bit like Adrian mentioned for Aviva, really attractive and capable people and with real digital skills are coming to work in the UK. And we would have a more optimistic view that they want to come. We just had an incredible guy from Holland who wants to come and work for us, amazing skills, because we're seen as a great place to work and a great country to work in. And I don't think personally that's going to go away, and we can actually build on the successes that we've had so far. And as we move into a more digital world, and the regulation around the world becomes a little bit more harmonized, we will be able to create industrial scale and technological scale that allows us to compete in many countries simultaneously, which has always proven to be, as Adrian mentioned, very difficult in Europe, because we've got these incredibly difficult and complicated local rules. And we'll hopefully see that disappear going forward and give us a bigger platform in which to grow.
So we're going to throw it open to the audience. I think there are only 2 mics, but we can have someone pass this around. But in the meantime, if anyone can bellow somewhat their question, including who they are, that'd be very helpful. This one here. Yeah.
Matthew Hall has some MLM regulation. I just wondered if you have any observations on the European Union is approach your history and the way questions, particularly influencing rates. Would you like me to repeat myself? Or I think I'm able. Yes, if you like. Sorry, Matthew Holhouse from MLEX News Agency. I just wonder if you have any reflections on the way in which you think the EU 27 might approach your industry and some of the questions in terms of regulation in the future without the UK's influence, without the UK seat at the table.
Yeah, I'll start with just a simple. We have a question on something very technical called the risk margin. I actually think there's a technical solution to that, which we will get support for right across Europe, because it impacts in various degrees across Europe, and that people made a mistake by lifting banking regulation and imposing it on insurance regulation, and they just made an error, and it was not a deliberate error in a sense. It was an easy thing to do, and the world looked very different in 2008 and 2009, and they just made a mistake. Everyone recognises it's a mistake, and there's a process to go through. I think Adrian made the point that we must be careful in managing that process, and that we're not trying to be too heavy-handed in coming to the solution that's perfect for the UK. But actually, will we get a pan-European solution to that? Absolutely. Will the other firms and EIOPA work with us, or the other countries and EIOPA work with us? Absolutely. And I think that will be good behaviour with a good outcome across Europe.
Yeah, I mean, I think I would agree with that. If you look at and obviously in the last few months, we've had reason to talk to a wide range of European regulators. I think they will carry on as they do countrywide with EIOPA, obviously playing a major role. In terms of the UK influence, obviously we won't have the same influence as we've had in the past, and particularly Lloyd's was a significant stakeholder in European regulation and contributor. But I think, on the other hand, there is a mutual recognition within the industry, at least, which I hope will rub off on the regulators, that there is a great benefit in working together and keeping the markets relatively open. So I would expect there would be a reasonable period of collaboration. If the one perhaps warning I would put is that if somehow we descend into what I call regulatory arbitrage, then I think it could become quite difficult. But I don't think there's any feeling that I have on either side that's going to happen.
I think you'll find we're all agreed. I think at the outset, it's natural to expect that our European counterparts will be worried about what might happen in the UK, where there's going to be a sudden dash for light regulation. It's quite clearly, I think, not where the industry wants to be. The industry is content with Solvency II. We work under Solvency II. We've got used to it. We spent enough money trying to get ourselves in order to get used to it that we're now comfortable. Absolutely, and the rest. And so I think there's going to be a period where there needs to be sort of mutual reassurance that no one's burning bridges. But I think that whatever the formal basis of recognition between the two systems going forward, which will only become apparent as these discussions bear fruit, actually, Europe has as much of an incentive to cooperate with the UK as the UK has with Europe. We are adjacent markets. We're both very big markets. It's in everybody's interest that prudentially and in terms of customer protection, the rules have similar effect. Perhaps they'll differ in their details, but there's absolutely no need, no desire for a bonfire of regulation in the insurance sector. I think that's very important to stress very strongly to everyone in Europe.
Thank you. I'm James Price from the Taxpayers Alliance. Brexit or no Brexit, insurance premium tax is due to go up again this June. I was wondering if that's seen as a big challenge, or what your thoughts were on that at all.
I think it's an increased cost to the consumer. We understand that government needs to create its revenue stream where best it can. We hope it doesn't go up any further.
Here, here.
Next question.
Linda Achan, Mansion Group. The panel touched on third countries. So I ask in respect of Africa. More and more Lloyds have an appetite for the speciality risk emanating from sub-Saharan Africa for reinsurance at Lloyds. I know that in 2015, there was a roadshow to East Africa to try to get more business. Does Brexit have any effect on this initiative?
Yeah. From a Lloyd's point of view, Africa is a continent which we are very present in. Our largest operation is in South Africa, mainly for historic reasons, but we have business actually throughout Africa. We see, as the economies develop there and as hopefully political stability increases, not everywhere, but that there will be greater opportunities for Lloyd's. And it's something that's very much on our strategy target, that we should develop a coherent strategy, not just for the southern part of Africa, but also the northern part of Africa. I don't actually think that Brexit will have any impact on our strategy at all. I think we will just continue as before, as would be the case with most parts of the world.
Margaret Doyle from Lloyd. Sir Adrian, with your background in government, I guess you knew what you were talking about when you spoke about the repeal bill and how long it will take to transpose the acquis of EU legislation directly into UK law. How long do you think that will take? And do you think that that is necessary, in other words, to continue trading properly or being properly regulated? And if so, do we need an implementation period that matches up to the length of that legislative process?
Margaret, I have no idea. The only thing I think I can tell you that this is the first time in my life when I've seen an activity that's going to be going on long after I've retired.
No, I don't know. No one knows.
It's Rick Saunders from Deutsche Bank. Just really, I wanted to ask, in response to Nigel's comment about the opportunities both in North and South America and Asia, etc., other than scale, which you've mentioned, why is it that you feel we're so well placed to take advantage of opportunities in other countries?
Yeah, I mean, part of it is technology, and I think the work that Aviva, ourselves, and other firms have done here is quite a long way ahead of our US counterparts, and certainly large parts of Asia as well. And we've been through a very successful transition in the UK to straight-through processing and use of robotics, use of the cloud, etc., very successfully in our industry, which easily go elsewhere. I think the brand recognition as well is something that we massively underestimated. The trust, authenticity around British insurance companies, led by Lloyd's but led by other firms as well, is much greater. And our research and indeed the evidence is that we're very trusted institutions, so technologically capable, already have a scale at a global level, very good people already, very strong balance sheets, and the trust authenticity of the brand travels incredibly well, not just in North America, South America, and indeed in Asia, but elsewhere. And we can now build scalable models as well, scalable financial models. And that in itself is another very positive outcome for UK firms.
I'll just echo what Nigel says. In Aviva's case, because we have this ambition to become a digital insurer, actually what we're finding is there's not a single model of being a digital insurer. In the UK, we're creating our own digital distributor. In places like Poland and France and Canada, where the agents are strong, we're digitizing the agents to improve their access to customers. And in some places in the Far East, we've got no distribution, and therefore we're looking to joint ventures with people like Tencent to distribute products through their platforms. And so there's a variety of digital initiatives in play at Aviva. And as Nigel says, I think we are, at least all of us in the UK, at the head of the field, if not leading the field. And I think combining the UK insurance industry's know-how and technical capabilities with distribution platforms of different descriptions around the world, I think that can take insurance into a different place, and is one reason why the future is so exciting.
Hi there, Bernard Goyder from the Insurance Insider. Just wondering, John and Adrian as well, in terms of the Brexit plans and the Brexit strategies of the organisations that you represent. We saw recently that AIG said it would set up a headquarters in Luxembourg, and we know that Lloyd is setting up a subsidiary in Brussels. And I was just wondering what your perspective is in terms of the strategy going forward, and if maybe if the panelists could very, very quickly summarise what their vision for the Brexit strategy is for the various organisations, and where we go from here effectively. What's the plan?
Well, I think I referred to it earlier in terms of Lloyd's, that what our plan is to set up, as you say, a subsidiary in Brussels from which we effectively will be able to give the market access to all 27 member states. And we've worked out a structure which basically means that we can place the business very efficiently into the Lloyd's market on that basis. We have a collection of offices around Europe anyway, which will, continental Europe, which will be linked into our European operation. And we think it will be seamless. Obviously, there is a cost in doing that because we have to separately capitalize the subsidiary. We have to introduce, management, compliance, all of that, so you can imagine. But as I say, I think that the strategy, our strategy, is to continue, on the one hand, to defend the business we have in the EU, but also I think we see opportunities to increase it because by the very fact that we're in onshore EU, it will help, and I think we've created a platform which actually will be quite attractive to non-EU carriers wanting to prosecute business in the EU. Now that's long term. That's maybe an optimistic view, but I think it's there. So that's our strategy.
I mean, I think that for a retail insurer like Aviva, with operations in Poland, in France, in Italy, Spain, Ireland, Luxembourg, and a book of business in Germany, we've got the elements to move the business around to where it can best be conducted post-Brexit. But you tell me what Brexit is going to look like, and I'll tell you what our plans are going to be. So we're all contingency planning. We're all planning for a variety of outcomes, but there's every reason to be prepared. You don't necessarily want to be the first mover. You don't want to anticipate the outcome of the negotiations. But I don't think it matters to the retail insurers. We'll manage. And I think there'll be a bit of frictional cost. We'll have a bit more capital overseas, but we'll manage. And there will be no operational impact. And I think that's the most important message of all for the retail sectors.
Yeah, I think when Brexit was happening, there was a great fear of what are the consequences. I think you've heard from all three panel members that actually we're all going to manage very successfully out of it. And we've realised by doing very detailed business reviews, we've actually got more opportunities to expand internationally outside of Europe than we probably thought prior to doing all the work. We were looking very much at the downside scenarios of Brexit. We've now started looking at the upside scenarios of Brexit, and lo and behold, John mentioned, Lloyd has moved from the dial being over here to the dial being over here, and is looking very much opportunistically at growth opportunities, and certainly Aviva and ourselves. Do I think we will generate more assets from our European businesses in the future than we are at the moment? The answer to that is absolutely yes.